In this episode, we're going to look at a company's debt level. Should you invest in a company with high debt or low debt? And does that impact your investment returns? Hi, I'm Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. In this episode, we're going to cover the following 5 topics. First, we'll give a definition of what is company or corporate debt. Then we'll take a look at the type of debt that we look at before investing in any company. Then I'm going to show you exactly how to calculate the debt for any company anywhere in the world. Then we'll take a look at what's wrong with a company having high debt. And then we'll compare some companies with some real life examples. Just a quick reminder before we get started, especially if you're new to this podcast, our approach to investing is to invest for the long term and build a resilient portfolio that generates growing income each year for you. So the key words here are long term. We have a long term perspective when it comes to investing. We want to build a resilient portfolio that's going to keep growing regardless of what happens in the stock market or market downturns. And it's going to be growing that income for you each year over the long term. So let's get started. Our first topic is what is company debt, or also known as corporate debt. So it refers to the total amount of money a company owes to creditors, including loans, bonds, and other financial obligations. So there's different kinds of debt. We've listed some of them here. So of course, loans, if you're borrowing money from a bank or another financial institution. A company could also issue bonds to other investors, but that money has to be paid back eventually to those investors. Lines of credit, just as you would use a line of credit at home, companies can also have access to lines of credit. And then, of course, there's accounts payable. So these are short-term debts that a company will owe to its suppliers for things that it needs to provide goods and services. So at the end of the day, company debt or corporate debt refers to the total amount of money that a company owes. So now let's take a look at what kind of debt are we looking at before we invest in any company or in any stock. So there's different types of debt ratios. We've got debt to equity, we have debt to assets, debt to capital, or debt to EBITDA, which is earnings before interest, taxes, depreciation, and amortization. So we're going to keep it simple in this episode. There's a lot of different debt numbers that you could look at. There's lots and lots of values that you could look up. We are going to keep it simple. So for the rest of this episode, we are going to be looking at long-term debt to equity ratio. So what is long-term debt? Okay, this is any debt that a company owes that is not due for repayment within the next 12 months. Because if it was, we would refer to that as short-term debt. Okay, so I'm going to repeat that again. Long-term debt is any money that a company does not owe within the next 12 months. So it's 12 months or more. So that is what we refer to as long-term debt. The equity piece means shareholder equity, also known as owner's equity. It represents the residual value of a company's assets after deducting all liabilities. Essentially, the amount that would be returned to shareholders if the company were liquidated and all of its debts paid. So in other words, shareholder equity is the net worth of a company. It represents the owner's stake in the business after all the debts are settled. Now you can have positive equity or you can have negative equity. So if a company has positive equity, it means that its assets exceed its liabilities. On the other hand, if it has negative equity, it means that the company's liabilities exceed its assets. And so that's not a good thing. So if you were to look at shareholder equity and the number was negative, that should be a red flag right there. because that could signal financial problems for the company. Okay, so we're going to stick with, like I said, long-term debt to equity ratio. And to keep it even more simple, I'm just going to refer to this as debt. So going forward in this episode, when I say debt, we are looking at long-term debt to equity ratio. So let's move on to our next topic. How do we calculate debt? So I'm going to show you a real life example on how to do that. And we are going to use Nike as an example. It's a popular brand. Everybody knows about this company. Probably have some sneakers at home from Nike. So let's take a look at what is the company's debt today, as of this recording, right? So it's going to change, of course, next time you watch this video. But as of this recording, as of today, let's take a look at it. So the formula is really simple. You can see it up on the screen. It's the long-term debt divided by the shareholders' equity. So where are you going to get these two numbers? Because that's what we need to fill in the formula. So first place to go is to look at the company's annual reports or quarterly reports. So now you can go to the company's website themselves under the investors page, and you can download the annual reports or the quarterly reports. You can go to some websites. We are going to use a site I'm going to show you right now in the next slide. You can Google Finance, any of these sites that give you, pretty much any site that gives you stock quotes, you're able to look at the company's financial statements. And the one we're going to focus on is the balance sheet. Okay, so in this example, I'm going to use barchart.com. It's free, so you can use it yourself. Just go to the website, search for the company name or the company stock symbol, and then you'll see, click on financials. And right below that, you'll see we have balance sheet, right? So these are all the financial statements that are available to you. Click on balance sheet. And now we're going to scroll down to the liabilities section. And what we're going to look at and what we're interested in is the long-term debt. So you can see up on the screen, I've highlighted that. And as of this recording, it is $7,903,000. So let's take that number, we'll put it aside. We're going to scroll down a little bit more. We're going to look at the shareholders' equity section. And again, it's highlighted on the screen. We're interested in the total shareholder equity, which is $14,430,000. So now let's take both of our numbers that we have and put them into our formula. So you can see $7,903,000 divided by $14,430,000. And you can see that we end up with a number of 0.548. And it just looks a lot nicer if you multiply that by 100, because we want to express that as a percentage. So as of today, as of this recording, Nike has a long-term debt to equity ratio of 54.8%. Now, you can do this with any company anywhere in the world, and you can get these two numbers and calculate the debt for yourself. If you want to do it a lot faster and a lot quicker and get the debt number quickly, I would, of course, highly recommend you take a look at our Simply Investing web application. I'm going to give you a screenshot here up on the screen. I've got a couple of companies that I just picked up, and you can see on the table, and we've highlighted our column in red, and that gives you the long-term debt to equity ratio. And you can sort that number from high to low or low to high. And our web application calculates that value every single day for every single company in the US and in Canada. So that's going to make it a lot easier for you to go in. You can also search for specific companies if you were looking for a specific company. You can search for it, and the web application will immediately tell you what is the long-term debt to equity ratio for that company. So what's wrong with high debt? So you just saw in the previous screenshot, a couple of companies have high debt, some of them lower debt. So what's wrong with a company that is carrying a lot of debt? So I'm going to give you 5 different types of risk that a company could get into if they consistently carry a very high level of debt. So risk number one is going to be a higher financial risk, because at the end of the day, the debt needs to be repaid regardless of a company's revenue or profitability, right? Because the creditors don't care whether you're profitable or not. Doesn't matter to them. They need to get paid, right? Because they've lent you the money. That money needs to get paid back. So a company with a high level of debt, that's going to put a strain on their cash flow. And especially during a market downturn or a market crash, right? That gets even harder and harder for companies that are carrying a very high level of debt to survive a prolonged market downturn. Number two, of course, is the interest payments. So if interest rates go up, then that's going to get a lot more expensive for a company that's got a lot of debt to pay off their loans. And what happens then is then they have less money to pay out to shareholders, for example, as dividends, right? So that's going to get, again, very difficult for a company that's got carrying a lot of debt to be able to afford to pay off even just the interest on that loan if interest rates continue to rise. Number three, there's also its reduced flexibility, right? If a company is carrying a lot of debt, then they don't have a lot of money left over to reinvest back into the business for expansion, for innovation, even for acquisitions, right? Because a lot of their money is tied up in paying back their loans. Number four, it's going to have an impact on the company's credit worthiness, right? Just like people have credit ratings, companies have credit ratings. And a company that's got a lot of debt is going to have a hard time being able to borrow money from lenders. Or they're going to have to pay a lot more in interest to be able to borrow money from lenders. So that can get also very expensive. And finally, number five, there's market perception. And just like we're talking about in today's episode, is I'm teaching you how to take a look at a company's debt level, and that's going to be either a red flag or a yellow flag when you're looking at it. So investors often see high debt levels as a sign of financial instability. So that could potentially lead to a lower stock price and reduced investor confidence in the company. So as investors, we don't like to see companies carrying a lot of debt. So therefore, this is to say that lower debt is going to be better for a company. So now let's take a look at comparing a couple of companies. We're going to look at some real life examples, and we're also going to see, does this impact your investment returns, right? So let's start off with just two examples, and we're going to look at two companies here. The first one is T. Rowe Price. The other one is Franklin Resources, which is most commonly known as Franklin Templeton. Both of these companies are direct competitors. They provide asset management services for individuals and institutions, and they both compete in the same sector, which is financials. And if we take a look at managed assets, T. Rowe Price currently has a little over $1.6 trillion in managed assets. So that's a lot. Franklin Templeton is just right up there, almost, if we round that up, it's almost 1.6 trillion, right? 1.577 to be exact. So they're both relatively managing the same amount of assets at the end of the day. So competitors, they're in the same sector. Let's take a look at their long-term debt to equity ratio, right? What does their debt look like? And again, this is as of this recording. It's going to change over time, but as of this recording, T. Rowe Price has a debt of 0%, and Franklin Templeton has a debt of 95%. Now, this doesn't mean Franklin is a company that you should just avoid. There's a couple of other things to look at, and I'm going to get to that later in this episode. But all things considered equal, right? If you were going to invest, let's say, even $1,000 or $5,000 or $500 or $10,000, all things considered equal, again, we're going to just assume the yield is the same, the payout ratio is the same, everything else is the same, T. Rowe Price is going to be a better investment because the company has no debt whatsoever, long-term debt, which is great. Franklin is sitting at 95%. Let's take a quick look at 7 other examples. And these are a little bit more extreme, but I want to share these with you because this is the reality. As investors, we should always take a look at the debt level, and some of these numbers will surprise you. So what I did is I went back to the Simply Investing web application, put in 7 stock symbols, sorted the list from low to high. So if we take a look here, you can see at the top of the list, Cisco Corporation, that's SYY, is currently sitting at over 560% debt. If we look at Kimberly-Clark Corporation, they're at over 700%. Home Depot is at over 730% debt level. AbbVie is at over 1,800% long-term debt to equity. And then finally, Colgate-Palmolive is sitting today at over 3,438% long-term debt to equity. So to me, again, all things considered equal, we're not looking at other, are the companies priced high or low? What's the dividend? What's the payout? Disregarding all that just for a minute, just looking at this table here, these are red flags. These are companies, they are carrying a lot of debt, right? So that is an issue. Now, I know some of you are thinking, of course, companies like utilities generally have more debt because they're more capital intensive businesses. I understand that. We cover that in more detail in the Simply Investing course. Today, I just want to keep it simple. We're just looking at just the debt numbers. And so I just wanted to share with you these 7 companies, and having a debt of over 900%, over 1,000%, or even 3,000%, to me, that's a red flag. That is something you'd want to look at. If you're still interested in looking at these companies, then that requires further investigation. If you don't have the time for further investigation, then just looking at these numbers here, skip it, move on to something else. Now, does the debt impact stock investment returns? Right? Because that is key here. You are investing your hard-earned money into these companies, and so you want to know, is this going to be a good investment over the long term, or is it going to be a bad investment? So in this example, we're going to look at 2 real-life examples. We're going to look at Conagra Brands, stock symbol is CAG, and then we're going to look at ADP, stock symbol is ADP. Now, I know these companies they're not competitors. They're in completely different sectors, completely different industries. But the purpose of this segment in this episode is just to compare the debt level, right? The 2 extremes you'll see in a minute here of debt level. And we just want to see over the 10 years, which one was the better investment. And of course, it's hindsight. We're looking back at the last 10 years, but let's just see as an example, right? So the reason I picked these 2 companies is not because they're in the same industry or sector, which they're not. I picked them because of their sharp contrast in their long-term debt levels. So we're going to go back to 2015 because we're going back 10 years, and you can see the share price for ADP was $82.53. Conagra Brands was $28.92. If we look at the dividend per share, ADP back then was paying a dividend of $1.95, and CAG was paying a dividend of $1 per share. Now that's the annual dividend for both of the companies. Now, if we take a look at the long-term debt to equity ratio, ADP back in 2015 had 0%. So 0% debt. Conagra Brands was sitting at 167% debt back in 2015. Okay, so this is the reason I selected these 2 companies, just to illustrate what's going to happen over the next 10 years, right, starting at 2015, with each of these 2 companies. And so you can see there's a stark contrast between 0% debt and 167% debt. Now imagine you invested $10,000 in each of these companies. Okay, 10 years later, we're going to fast forward to today, 2025. Which company comes out ahead? Let's take a look. So if we look at the share price today as of this recording, ADP is now at over $300 a share, which is fantastic. That's been a huge jump in stock price over the last 10 years. CAG is actually a little bit lower. It was around $28 back in 2015. It is now at $26.59. Now, both of these companies have continued to pay dividends over the last 10 years. ADP has increased its dividend every single year. CAG has not. They've kind of maintained it for a couple of years, then the dividend went up. The dividend today, as of this recording, for CAG is $1.40. So it's gone up. It used to be $1, so it's gone up to $1.40. ADP, remember, was $1.95, is now at $6.16. So it's rapidly increased its dividend. Now, if we look at the long-term debt to equity today, so we can see that ADP, which was fantastic, it was at 0%, now is carrying some debt. It's at 59% now. So that's not a good thing. They went from 0 to 59. CAG, on the other hand, has done a little bit better. They were at 167%, and now the debt has come down to 71%. So they're kind of in the same ballpark now, right? 60% versus 71. But that's where they are today in terms of long-term debt to equity. Now, the most important thing here in this segment is what is the return on investment since 2015? Which company comes out ahead? So if we calculate the return, which is the capital gains, the share price has gone up, plus all of the dividends received over the last 10 years, right? So you can see that ADP has had a return of 319%. CAG has had a return of 33%. So that is a huge difference. The gain is over 200%, 215% difference in the return in both of these companies. So in hindsight, we're looking at both of these companies back in 2015, in hindsight, it would have been better off to have invested in ADP. You would have gotten a much better return. So does the debt impact stock investment returns? Yes, absolutely. So that is something you need to look at. Now, does that mean that you should go out and buy any stock today that's got very low debt or even 0% debt? And the short answer is no. Okay, remember, our job is to invest in quality, dividend-paying stocks when they are priced low. So how do you know when you're looking at a company if it's a quality stock, and how do you know when you're looking at it if it's priced low? So for that, I've created what I call the 12 rules of simply investing. The rules are designed to lower your risk, save you time, and help you earn more. And you can see them up on the screen now. I've got 12 rules of simply investing. A company has to pass all of the 12 rules before you invest in it. If it fails even one rule, skip it. Move on to something else. And today, this episode, we looked at rule number 8. And you can see it on the screen. Is the debt less than 70%? So that's the cutoff. If it's higher than 70%, we skip it, we move on. Now, I mentioned a little earlier in this episode, there are going to be some exceptions to this rule, because if you're looking at utilities, for example, those companies are capital intensive. They will have much higher debt levels. And so we get into details about those and what the exceptions are and how to handle them in detail in the Simply Investing course. So nevertheless, that's rule number 8. You can see it up on the screen here. So rule number 1 is, do you understand how the company is making money? If not, skip it. Move on to something else. Rule number 2, 20 years from now, will people still need its product and services? Rule number 3, does the company have a low-cost competitive advantage? Rule number 4, is the company recession-proof? Rule number 5, is it profitable? Rule number 6, does it grow its dividend? Rule number 7, can it afford to pay the dividend? And rule number 8, of course, the debt should be less than 70%. Rule number 9, we avoid any company with a recent dividend cut. Rule number 10, does the company buy back its own shares? Rule number 11, is the stock priced low? So we're going to look at the PE ratio, the PB ratio, and we're going to compare the current yield to its 20-year average yield. And then rule number 12, keep your emotions out of investing. So I've created the all-in-one solution. It includes the web application. I've shown you a couple of screenshots in today's episode. It also includes the Simply Investing dividend course. So the web application will apply the Simply Investing criteria to over 6,000 companies in the US and in Canada every single day. So you can immediately look at a company and see which one has low debt, which one has a lower payout ratio, which one is priced low. You can see that right away. And it can also show you which companies to avoid, right? The ones that are priced high or overvalued. So then you can quickly skip those and move on to something else. So that's the Simply Investing web application. The course is divided across 10 video modules. It's self-paced, so you can take your time going through it. Module 1, I cover the investing basics. Module 2, I cover the 12 rules of Simply Investing. In Module 3, I show you how to apply the 12 rules to any stock anywhere in the world. Module 4, I show you how to use the Simply Investing web application. Module 5, placing your first stock order. If you haven't done it before, I take you through that step by step. Module 6, building and tracking your portfolio. Module 7, when to sell, which is just as important as to know when to buy. Module 8, especially if you have mutual funds, index funds, or ETFs, we talk about how to reduce your fees and risk. Module 9, I give you your action plan to get started right away. And Module 10, I answer your most frequently asked questions. So if you're interested in the all-in-one solution, the course and the app, you may want to write down the coupon code SAVE10, SAVE10. It's going to save you 10% off of our all-in-one solution. If you enjoyed today's video, please hit the subscribe button, hit the like button as well. And for more information, take a look at our website, simplyinvesting.com. Thanks for watching.